Hello and welcome to another Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com, and in this video I am going to take a look at some areas of the market, numerous areas of the market, to assess what we should be looking at with the SPYs sitting right at the 200, and also take a look at the use of both momentum and phases at the same time so that we can establish which stocks or sectors, and in this case even countries, are in better shape than the others, even though they may all look the same on your typical 50 or 200-day moving average. But before I get to the details, I just want to make sure if you're just finding us on YouTube, please subscribe to our channel. If you're not watching this on our site, you can find more videos like this at www.marketgauge.com/tutorials. And we also put out a lot of information on Twitter through two feeds, at Market Gauge and at Market Minute. And of course, if you're finding us on Facebook, like us and be sure to check out our site as well. So the last couple of days in the market have been a bit of a jolt, and the question that should be on everybody's mind is whether or not this Brexit drop is the beginning of something new that will lead to more declines, or have we just come down to the 200-day moving average and have the potential to bounce back and either continue our range-bound trading or even better, head much higher. All right, so there's a few simple rules that you can follow to get a sense of that. I'm not going to go into them in this video in too much detail. And there's also a video we put out every weekend called Market Outlook, where we go into, Keith goes into details of looking at market internals and all different measures to try and figure out which way our markets are going to go. So if you didn't see that this weekend, go to Market Outlook on our site. It's free, just like this one, and you can get the market internals. With this video, we have the benefit of having seen the reaction to last Friday, and if we just focus on the on the SPYs for a second, the reaction was down yesterday, and then today it's up. Now, one of the simple rules I was just talking about is the first thing to look for is to find a day that closes over the high of the prior day. So until the market does that, it really hasn't reversed in any significant way. For the purposes of this video, I'm going to just take a look at what areas of the markets, or what areas within the markets, have come down and maybe are challenging either their 200 or their 50-day moving average, and what should we expect that to be telling us about the rest of the market. All right, so if you're just looking at these four market watches, we call them SPYs, Qs, diamonds. Sorry, my pen is not working great. IWM in the lower right. That's fine. It's a good start. You should also be looking at the modern family as well through MISH, which is an extension of this into several industry groups. And you can simply just look to see, find a day where the market closes over the prior day's high. And that's the beginning of what could be a reversal. I cover this in a lot of different webinars, so I'm not going to go into the extra details here so that I can go into some other stuff. And that other stuff has to do with combining momentum with the phases. All right, so what do I mean by momentum? Well, when I talk about momentum, I'm referring to our Market Gauge Real Motion Indicator. And the Real Motion Indicator is one in which we measure the momentum of the market, and we measure it in a way that it should line up with the 50 and the 200-day moving average on individual charts. So before I get to SMH, let's just go back to SPY to keep this a little consistent. And here's what it does for you. The momentum indicator, or the Real Motion Indicator, is on a daily basis these brown dots. All right, so we have dots rather than a line. It makes it easier to tell this indicator from other indicators. Also makes it sometimes easier to see the extremes that it's at. And the simplest way to use it is you've got a 50-day moving average of the momentum in blue and a 200-day in green. You've got the same thing up in price here, where 50-day move in price is blue and the 200-day is green. For those of you interested, the magenta is 10. That's not relevant to this conversation, however. And what you want to see is that the momentum down here, or real motion, is doing the same or running ahead of what the market's doing. And that's how the basic way to use it, to either confirm something or give you a heads up. So for example, we had a heads up in the SPYs. As the SPYs were coming off their bottom in February, the momentum or real motion broke its 50 before the price did. So when the price broke the 50, you already had somewhat of a confirmation that the momentum going into that 50 was strong. Likewise, the momentum broke the 200 long before the price broke the 200, so that was a confirmation that this move up had, well, momentum, and that's what you want to see. It had power behind it. So then when you pull back to the 50 in terms of price, you ideally want to see this hold the 50. All right. In this case, it pretty much did the same thing as the SPY. So it's confirming that had this broken down, it would have been weak. Now, what just happened? Well, the momentum on the SPYs has pretty much confirmed the action of the price in the SPYs. So we're not getting any major insight here other than to say that it doesn't have to be doing the same thing. We could easily have, as we'll see pointed out, or we saw here, you could easily have momentum running ahead of the market on the downside, and that would be negative. So it could be more negative here, but it's certainly not saying that it's positive. Now let's take a look at IWM. And you'll see difference. All right. So in terms of momentum on IWM, when IWM pulled back to the 50 here, the momentum, or real motion, didn't break the 50 as the price did. So that was an indication that if IWM turned higher, we should expect the move higher to actually go higher, which in fact it did. Now, when the market gets shocked with a news event like this, you can't expect that it's going to know what happens before the news event. But now after the news event, we can see that IWM was pulled back down to under its 200, but the momentum, or real motion, has not broken its 200. Now we do have to give it a little bit of time. These things aren't so specific to the day, but if IWM rallies and SPY rallies and the other ones rally, IWM is telling you right here that from a momentum point of view, we really didn't break that 200-day barrier. All right, and 200-day in IWM or in any market in terms of price action is a significant level. All right, so first thing is you've got SPYs kind of confirming the break of the 200. You've got IWMs not confirming and suggesting that if the market bounces, it's a bounce that you could follow. Neither of these two are saying if the market moves lower, you shouldn't follow it lower. All right, so let's establish that right now. The easiest way to figure out which way this market is going to go next, because the SPYs are now trading over the prior day's high, especially if they close there, is to just box in this day, and this is a big day on IWM, so I'm not just saying this about any day. IWM over this 208 level is holding support. IWM under this 208 level is breaking a major level of support, which the Qs have already broken. I believe the SPYs also have already broken. So at this point, this is a really straightforward way to tell which way the market might go. Just follow it whichever way it goes relative to that IWM day on Monday. But let's take a look at some other areas of the market. First, I want to take a look at some of the areas that have been strong and see how they've held up. IWM was one of them. XLV. All right, so all I'm really doing here is taking a look at how these sectors that we provide in our little big view area. So I'm in the sector summary. Let's take a look at some of these sectors and see how they're performing. So XLV recently up about 1.5% over the last 3 months. There aren't many sectors that have been up over the last 3 months, even fewer over the last 6 months. But before I actually go to the individuals, let's take a quick look at what's going on here in terms of the sectors. So the idea, now this is produced weekly. So as of Friday, we could see that we still had a fair number of sectors that were up on a 6-month basis. That's what this is telling you. And when you have that and you're over the 200, it's a sign of being bullish. Now, when you're under the 200, all bets are off, all right? What we want to watch out for, and so this is the aggregation of these sectors that are bullish up here in 6 months. So now we've got 1, 2, 3, 4, 5, 6 as of today. That number starts dropping down to 4 or below 4, and you're under the 200-day moving average, it's really negative, right? So if we just take a look, and what I want to take a look at is some of the sectors in here and see how their momentum is lining up with their phase. So XLV, as I said, had been one of the stronger ones over the last 3 months, not necessarily over the last 6 months, but I knew that it was pulled back to the 200. And as a result, let's take a look at its momentum. So now its momentum hasn't broken down below the 200. So this would suggest, just like I said with IWM, that if you're looking for something that has been pulled down by the market, and the momentum of it hasn't broken yet, XLV fits that bill, and it's right back down to this level of support that it's bouncing off of. So again, that's simple. Look for the reversal pattern and then follow it higher if you're looking for something to look to the upside. Now, this one isn't a leader, but if the market was going to really fall apart, we would expect that some of the weaker areas would fall apart. Now, on a price basis, you'll notice that IBB has been really weak over this year. So its 50-day never got over its 200-day. It's not trading down to its 200-day. It's actually trading under its 50 and under its 200. So this thing is in a bearish phase as opposed to the overall markets, which up until a few days ago were actually in a bullish phase. So if this market is going to really fall apart as it did in January or as it did in 2008 or 2009, the weak areas of the market aren't going to hold up either. So IBB represents a really interesting look here for a couple of reasons. One, you can see by the real motion that actually the momentum has been gaining strength as this thing has been going sideways. And if you've been following my videos, you know I've been on top of that with the move above the 50 here and then the move above the 50 here. And in part, that was because I could see that the momentum was strong. Like you could see the retracement to the momentum down here was just down to the 50, where in price it was under. When this moved higher, the momentum broke the 200 and the price was nowhere near it. So this thing has had and still has huge potential for a bottoming formation. These momentum shifts happen over time. You can see that up near the top here we have the opposite, where this momentum was actually breaking down as the IBB was making new highs. So when IBB broke the 50, it was already trading in a bearish phase, the 50 under the 200 and momentum under both. So that was, I don't want to say an obvious, but it was a glaring divergence. And so this, while not quite as glaring yet, will be if momentum comes back over these levels here. Now, what does that mean? It means that if IBB continues to rally to the upside after taking out this low and the rest of the market holds strong, keep an eye on IBB. You could see a pretty significant move to the upside here, so long as the market holds, right? So these are areas of the market you want to keep an eye on if the market turns higher. All right, so let me take a step back. Why would I even start to consider the market turning higher even without the phases? Well, first of all, let's take a look at Great Britain as a stock market. Now, I wouldn't go rushing into this one. However, if the rest of the world was going to fall apart because of the UK, then I would expect the UK to continue to fall apart. But the UK just came down to its January lows, and today bounced significantly. So just like I said with our markets, I think you've got a really easy floor to keep your eye on. If things are going to fall apart, this is going to break this floor. Until it breaks that floor, I'm not saying the markets can't go down, but it seems unlikely that we're going to really have a total collapse. Along those same lines, I would expect that the emerging markets would also be susceptible to some pretty significant declines here. And yet, what did the emerging markets do? They held their May lows. And the other thing that you can see now with the emerging markets is that from a momentum point of view, they came back under their 50, confirming that the move under the 50 was, I guess, legitimate. But they came under the 200, and the 200 period momentum measures way down here. So the momentum in the emerging markets, kind of much like I was describing with IBB, there's a big shift in momentum that underlies what looks like a base here. All right. Now, what does that mean? If the emerging markets continue to trend higher, if the UK market continues to trend higher, then we may have just seen a knee-jerk reaction that isn't going to lead to a huge slide. And in order to protect yourself from just sticking your head in the sand and thinking it was just a new knee-jerk reaction, all you have to do is use these significant floors as your stop. All right, so keep an eye on those two foreign ETFs in order to have some perspective on the seriousness of the decline. So back to the U.S. and what I would have described as one of the leading sectors going into the Brexit vote that wasn't a defensive sector, all right? SMHs. Now they got hit pretty hard, and they came right down to the 200-day moving average. So they didn't break the 200 like the overall markets did, but they came down hard, bounced on it. And from a momentum point of view, the momentum's doing basically the same thing. It's not, I wouldn't call it bullish or bearish, but it's certainly not bearish, okay? It's just confirming. So keep an eye on SMH, keep an eye on XLV, and keep an eye on IBB as a weakling that would suggest that the markets, even the weak, can rally if all these things start to rally. Now, it's not all good out there, all right? Let's take a look at XLP. So XLP has been one of the stronger areas of the market, and it's probably for good reason. It's defensive. Now, this, on the other hand, you can see is not really exhibiting what we want to see in terms of momentum. In other words, when it pulls back to the 50 here, the momentum really got hit hard. When it rallied up, the momentum didn't make a new high. When it pulled back, the momentum got hit really hard. So this is an indication that underneath this sideways action, the momentum actually seems to be rolling over. And now you've got the momentum well below the 50 while this sits on the 50. Now, I suppose this could be interpreted as good or bad if you were to say that consumers' staples are defensive. However, I would be really cautious if consumer staples start to break down here. We know from the real motion that the momentum there is waning. All right, so one thing we don't want to see if the markets do start to slide is consumer staples sliding with them. Now, another area that has been particularly negative is the XLKs. Right? Now, XLKs, you can see the momentum down here has really broken down along with this break of the 200. So it's really confirming this break. So if this rallies back up, okay, can't argue with the price action. However, if XLKs continue to break down lower, and this is just like I said with IWMs, this has already broken this key level of support. Same thing is true of the Qs. But if this breaks, what are we saying here? We're saying that it's broken and the momentum is already broken as well. So it's not like the IWM where you have that indication that perhaps the momentum is going to lend some support to it. All right, so on the weak side, keep an eye out for XLPs breaking down, XLKs continuing to break down. And if that happens, then you want to be raise your level of caution. All right, so if you've got EEMs and the EWUs breaking down as well, that's when you know that things could get ugly again. However, if XLV rallies, if IBB rallies, if SMH rallies, and the markets continue to rally, those are all areas you might want to take a look at to take a shot at the fact that this could have been a knee-jerk reaction and we could go right back into the range. Hope that helps, and I'll see you in the next video.